You're watching Silver News Daily. Subscribe for more.
This time is different because the debt market has lost its footing and is now no longer a reserve asset of accumulation and that people want to hold. And in actual fact, gold is the beneficiary. I suppose that's the sunlight in what's a pretty doomer statement, is gold is here and it's big. Unfortunately, we're going to find out who owns the gold and who didn't. It's going to be a very polarizing event.
The debt system is detonating right before our eyes, and almost no one is prepared. The US, Japan, and Europe are drowning in liabilities that can never be repaid, and now the bond markets are breaking. Banks are starting to crumble under the pressure, sending shockwaves through the financial system and lighting a fire under gold and silver. But this isn't just a safe haven rally, it's a systemic fracture that's about to unleash a once-in-a-lifetime explosion in the price of silver. Physical supplies are vanishing, vaults are being drained, and premiums are soaring. The institutions that once laughed at silver are now scrambling to get exposure, while retail investors are waking up too late. And as the BRICS nations dump the dollar and prepare for a post-dollar world, the floodgates for silver demand are about to burst wide open. The question isn't if silver will pass $500, it's how fast it will happen once the panic begins. This is a financial reset, and silver is about to be at the epicenter.
Oh, wow. Yeah, long ends of debt across the world, in fact. So September 2020 was when American debt came into focus for us, and we called short and we traded the TLT then and again, and you lost around 45% in the next 2.5-3 years, which has subsequently seen a lot of big names also positioned to the short side, which some of them were mentioning in November of last year, like Stanley Druckenmiller and Paul Tudor Jones. However, this focused, America's collapse in debt has focused people's minds across all the nations. So after 2020, after that call, we actually took a look at British debt, we took a look at European debt, and we took a look at Japanese debt. And we came to the conclusion that we expected, actually, especially on the long side, long by duration. So that means 10, 20, and 30 years. I don't want to be too jargony. Many people don't understand bond markets. So long durations rather than 1 and 2 years, which would be considered short. And what's happening is those rates are going up. And the longer you are facing what is a financial repressionary environment, so that is, we need to devalue debt. So we're actually paying a much lower interest rate than is the true inflation rate. Particularly in stagflationary times, the inflation rates often get masked because there's downward pressures due to lack of growth and a lot of people feeling a recession at the one time. And then actually in terms of costs of living, there's quite strong upside. So there can be a sort of a dimming and a brightening aspect, countervailing forces. But in actual fact, it's stagflationary. And this is very much like Volcker during the 68 to 82 was a stagflationary period. Equity markets barely went anywhere. Things devalue. And we're going to have a bigger hyper version of that. In fact, we've begun to experience that. That's our overall opinion. And that's being led by devaluation of debt. So the rates going ever higher, a lot faster. In the Japanese, everyone assumed Japan's just barely over zero. And quite some time ago, we were doing YouTubes in 22, 23, talking about Japanese debt. They got the worst viewing numbers of everything. If you talk about Japanese debt market, it's absolute lose everybody. I mean, 50% of our audience is American, by the way. Thank you to America for your support. A large part in the UK Commonwealth. You'll put people to sleep. But it didn't help us because I was going to do it anyway because I felt this was part and parcel of the great debt-based collapse. That means it's not just a US story, it's a global debt story. And this is why we've joked when we've come on board with you, we've spoken of lepers, the leper colony. We're all lepers. Not just American leper, there's lepers from all nations. We all kissed the same chief leper and did the same things and synchronized. There's no sound money nation, really, in truth, and there's debt all over the place. Now, the rates on many other...
We are living through the largest global debt experiment in history, and it's starting to fail spectacularly. Governments around the world have gorged on cheap money for decades, believing they could borrow forever without consequences. But now, the consequences are here. In Japan, negative yielding debt is turning toxic as inflation returns. In Europe, sovereign bond markets are showing cracks as interest rates rise faster than the ECB can contain them. And in the US, the Treasury is issuing trillions just to keep the system afloat, sending yields higher and threatening to break the entire bond market. The bond vigilantes are back, and they're merciless. As rates spike, the value of existing bonds plummets, leaving institutions with massive unrealized losses, just like the ones that helped trigger Silicon Valley Bank's collapse. This is not a regional issue anymore. It's systemic, and it's spreading. The debt load is so enormous that even minor rate hikes create chaos. And central banks? They're trapped. Raise rates, and they crush their economies. Cut rates, and they ignite inflation. Either way, trust in fiat currencies is eroding fast, and when that trust disappears, the money has to go somewhere. And right now, more than ever before, that somewhere is silver.
Nations are not quite as high yet as the US. European are lower, but they don't look after their military to the same degree. That's come up with the NATO discussions and Trump, and they're now having to spend more. So we've got upside setups across the board. Dutch, German, French, all the Northern European. Many people are a bit suspect and circumspect about the Southern European, but I'm showing you all the supposed legit nations in terms of financial prudence are all in upside technical structures for higher rates. And the UK is probably the closest to replicating America by being quite poorly set up and their rates going quite a lot higher. And I'll show you a couple of those charts. But what that means, Elijah, is that when rates go up, the debt needs to be devalued. It's going down. That's that hand. And when that's happening, it's good because you're shrinking your over borrowings, but it's bad because the rates are higher. And that means affordability of housing goes down. And housing is mathematics. It's, what is the average salary? How much can people put down? What's the likelihood on underwriting of them going bust? In other words, what's the environment like? A raising interest rate environment, borrowers are not very keen to borrow. They want fatter margins. They want bigger deposits. They decline more credit. They're going to be less flexible on subprime and damaged credit. And they are also going to price future increases. And the debt instrument they create, which is their asset, is no longer desirable for on-selling securitization to other investment companies that are in pension crises, because they've already stuffed to the gills with supposed debt instruments that have all lost immense amount of value. So debt is going out of fashion just as the most supply is ever coming into the stores. So that's why I always joke about pink Crocs. No one wants to buy them anymore, and you've got 6 oil tankers stuffed with them, bringing them to your store. It's the wrong product at the wrong time. That's deeply devalued. And in fact, you're going to pay to have people take them away, never mind an asset. And that's kind of where we are in the debt markets cycle. So governments are going to go into scavenge mode because they can't borrow as easily. So they need more tax. So you're going to get repressionary socialist agendas that are being driven, higher taxation, apart from the big, beautiful bill, which is more spending and actual tax breaks. But Europe, if you look at Starmer in the UK, is looking for bigger tax takes and is running out of money. He's chasing all his millionaires out. So Trump hasn't gone complete stupid, but all the cuts that were supposed to happen in doggy, that's all quietened down. Elon's cried off. And what's actually happening is the cuts all being pushed out, and it's all we spend now to make later. We'll always spend now to make later. So that's a can kick and very dangerous. And it shows we're not doing austerity, according to Donald Trump, whereas we're very big in the spend camp. And if it's Republicans, it's the military-industrial complex. And if it's the Democrats, it's quangos and welfare and inversion, perversion policies. So either way, both governments overspend.
As the debt news tightens, cracks are now erupting in the global banking system. Again, we've seen this movie before. But this time, the ending could be catastrophic. Liquidity is drying up, loan defaults are rising, and commercial real estate is becoming a ticking time bomb on bank balance sheets. Regional banks in the U.S. are already feeling the squeeze, with deposit outflows accelerating and trust deteriorating. In Europe, the situation is no better. Credit Suisse was just the beginning, a warning shot that even so-called too-big-to-fail institutions are not immune. And behind the scenes, central banks are quietly preparing for emergency interventions. They've reactivated swap lines, restructured bailout mechanisms, and expanded their backdoor support systems. But here's the truth. All of this is reactive, not proactive. The system is lurching from crisis to crisis, held together by duct tape and hope. What's unfolding now is a global bank run in slow motion. Savvy investors are no longer content keeping cash in an institution they don't trust. They're pulling funds and converting them into hard assets. And among those hard assets, silver is emerging as the stealth favorite. Not only is it more accessible than gold, but it's also still undervalued. And that's exactly what's drawing in billions of dollars of quiet, determined capital. Silver is no longer just an investment. It's becoming an escape hatch from a collapsing system.
I have to concur. There's no realistic. As I've said, I brought up a diagram a number of times. I should maybe bring it up with you as well. But it's very difficult to turn things around at the moment. Once you're on this convexity slope, I'll just share it. It's very simple, basic diagram, but it essentially shows that when debt starts losing its credibility, it starts slowly. It's very much the bankruptcy curve in actual fact. First, that's slowly. So the credibility and valuation, it devalues slowly, but then the compounding starts to take effect, and then it becomes very, very quickly. And we're in this period here where decades happen in weeks. First, it takes absolute decades for weeks to occur, and then decades occur in weeks. You get the flippening. We're at the slippy slope, and if you weren't able to turn around when you were heading down and it was a marginal muddy decline, now that it's slaty, wet, and getting steeper, you're going all the way down. You don't stop the snowball that you created in the top of the mountain halfway down the mountain. It's hitting the village. We've passed that point. There's no point of return. And what he would have needed to have passed to be in any way have half a chance of even reversing this, I don't believe it could have happened anyway, but he would have had to have done incredible cuts, massive withdrawals out of Europe on the military, all forms of things, all forms of massive culls in statist employment, and reversed everything Biden hired all the way back, and all the boondoggles, which is the arms dealing corruption. I call that, the hyena's carcass feast, because everybody steals from the American taxpayer there. So, you would have had to have just really done that. He's gone and put $1 trillion out, bragging about doing $1 trillion for the military industrial complex, whilst telling everyone else they need to fight for themselves. So, it mixed messages in there. It's a spend, and it's just absolute acceleration of the controlled demolition. So any chance of not growing the debt has actually gone super fast. It's going to come at you hard and fast. And the key point I make about this, Elijah, is we had the TLT that we shorted. It fell by 50%, which is long-term debt, basically from 2012, the date we mentioned. What happened is the dollar was pretty firm during that period. More recently now, you've had the dollar be really weak. That's against pretty poor company, it has to be said. The real company you should be comparing it with is gold, and we know what's happened there. It's been a virtual parabola recently. But even against the Dixie, it's fallen from around 110 to sub 100. And that is a part and parcel of what many people are not understanding. When the debt devalues, it's then the turn, but they can't keep watching the debt devalue. They have to put a stop on it, confuse it, muddy up the water a little bit.
As the West scrambles to manage its internal chaos, a new economic order is rising, and it's leaving the dollar behind. The BRICS nations, Brazil, Russia, India, China, and South Africa, are no longer content playing by Washington's rules. They're building their own financial infrastructure, their own payment systems, and yes, their own gold and commodity-backed settlement currencies. The message is clear. The era of dollar dominance is over. These nations are dumping U.S. treasuries at an accelerating pace and replacing them with tangible assets, especially gold and silver. And while the headlines focus on gold, it's silver that could become the real linchpin of this transition. Why? Because silver isn't just a monetary metal, it's an industrial powerhouse. As the BRICS nations expand their manufacturing base and energy infrastructure, they need silver to function. And at the same time, they're hoarding it, quietly, relentlessly. While Western investors debate Fed policy, Eastern central banks are moving their reserves into physical metal out of sight from COMEX reports and mainstream coverage. This is the quiet coup against the dollar, driven not by war, but by trade, money, and trust. And silver is at the core of it. The more dollars the BRICS unload, the more demand flows into silver, not just as a hedge, but as a foundation for an entirely new financial system.
Currency then has to take the whack for further devaluation. They still need the devaluation, but they can't. If it becomes a one-way bet to short the debt, you're just going to go into contagion and collapse. It's going to get disorderly. So they need a subtle way to devalue the debt for a while. They devalue the currency. But now everybody wants to do that because Trump's looking at a deficit, a trade deficit. He wants to make it more expensive for Americans to buy imported goods. A cheaper dollar has got to be the one to do that. But by doing that, he's reducing your living standards. And it's inherently inflationary as well. So he's going to push up the costs of everything that's imported. Now, some things you need are imported and you don't make them, or you don't make them as well. And, it's not a sin. It's not a criticism to say that. You can't be masters of everything. And the problem with that is that's imported inflation. That's a reduction in living standard. It's going to reduce disposable incomes in an already bad recession, which has been a recession many times. It's qualified for a recession many times, despite what they tell you for new rules. So this is a doom loop of reducing tax take, increased debt expenditure, higher welfare as people become unemployed at a faster rate, a crashing housing market as the rates go up on the long end, a rejection of loans, banks not wanting to lend anymore because it's high risk and the assets they create are undesirable in an overly provided, over-proliferated debt space as a reserve asset. Nobody wants it. So that's a doom loop, and it's got to play out, and it's very bearish. But the king reserve asset is doing exactly what he should be doing, and that's gold. But the point of showing you this chart is that you're going to suddenly, Americans that are watching this, and friends, I'm sorry to say it, but your buying power of your dollar is going to lose rapidly. At first it's debt, then it's currency, then it's debt, then it's currency, and then it goes like this, and then they go together. And that's the capitulation phase. There's become less pauses in between, and you're getting the full deflation as everyone does it. That's when gold turns parabola, though. That's the good news about that. And just to draw that chart, gold will be the inverse of that chart. So it goes kind of like this. If I can draw it, let's just draw nicely with you in orange for the gold. It'll look something more like this. And then suddenly it parabolas like that. So for all those thinking, should I be selling my gold? It's amazing. We've barely done, I don't think we've done much at all. Should I be selling my gold is the worst question you should have. You should keep stacking gold right now. It is the reserve asset in a failing debt asset, and we're only just starting to see interest rates that could go a lot higher across the world, by the way. And I don't want the guys to think that I'm attacking the US. So let me just show you the British debt so that you can at least feel that debt is collapsing in many other nations.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. Every time a currency system has collapsed in history, gold and silver have stepped in, not as alternatives, but as replacements. And this time is no different. As confidence in fiat currencies evaporates, a global reset is coming into view, and silver is about to reclaim its role as real money. Unlike digital currencies or central bank schemes, silver cannot be printed, cannot be devalued with a keystroke, and cannot be controlled by policy committees. It's tangible, finite, and historically recognized across every culture as a store of value. And in a world that's rapidly moving toward barter, bilateral trade, and resource-backed settlements, silver is becoming not just valuable, but essential. This is why the conversation around silver has shifted. It's no longer just about price targets or inflation hedges. It's about sovereignty, control, and survival. Nations, institutions, and individuals are waking up to the reality that paper assets and fiat wealth are fragile. When confidence cracks, people don't want IOUs. They want assets they can hold in their hands. And silver, with its monetary legacy and rising scarcity, is perfectly positioned to fill that void. As the dollar system fractures and new alliances form, silver won't just rise. It will be reinstated as the monetary anchor of a more decentralized, multipolar financial world.
If we show you the 20-year, we're calling for 7.5% there and have done for a lengthy time. We've shown this 20-year instrument on a weekly time frame. When it broke, it was, when we called it, it was around 4.5. It's now at 5.36. So that's quite a move already, and we're looking for 7.57. That's going to be 7.6. You could find someone needing a fixed for 20 years for a mortgage purchase in the United Kingdom, staring at almost a 10% rate, with margin and defense and protection, and if he's not perfect credit, and requiring big deposits. I mean, imagine that. The house pricing just has to re-rate because not enough people are cash owners in the property market, and all the lower demographic by age group has to have access to finance, and they need to borrow the most, not the older folk. And they are the people who will buy as people are passing on or downsizing, etc. So this is a very, very bad state of affairs. Japanese debt, we've called this one, wow, for a long, long time. You were down here at 0.2s, 0.3s. We had an amazing structure on this. Let me just get my draw tool back. That is since really, really ripped. This is super high. It's run up here. It keeps setting up. It keeps making new highs. You're at 3.2% on the 30-year. Let me show you German debt. This is the stalwart, the spine of Europe. You can see that it is at a lower rate than America for now, but in the long term, it's also going higher. Again, going higher. Beautiful technical setup here. You can see you were at almost negative rates a while back. You were at negative rates, and now you've got these structures with upside breaks to the upside now. Now, a little bit of a pullback right now. It's not the worst, but we have it going for 4%. The German rate. It show you the French. It doesn't matter who you run actually through this. There are upside structures for higher rates across the board. You can almost fit them. They're not that different, being as part and parcel of the EU. We expect up top there 4.5 going higher. These are moving higher. The Japanese, as you mentioned, the big concern with Japan, Elijah, is that the carry trade is based on that. A lot of speculative money that's gone into America, borrowed in a Japanese bank, in yen, sold yen, bought dollars, and either put it in treasuries or Mag 7. If that has to reverse now because the cost of that funding is now getting too expensive, what ends up is you have sell the asset, which will be the stock market or the treasury, not a desirable outcome. That'll push rates up on treasury. It'll crash the stock market. Sell the dollar, repatriate back, buy the yen, by the local treasury, if it was a Japanese lady that went searching for yield in America, or if it was an investment fund or hedge fund in America that borrowed there, or Switzerland for that matter. It's not only American institutions that have made use of the cheap Japanese financing. If that reverses, you can have all sorts of problems and you get contagion in the debt markets, because that will mean the most speculated in nation, which is America, expect mainly for the stock market and the unicorns. But if you get a withdrawal there, the worst thing that could happen is Mag 7 starts selling off and it's foreigners that are selling. Don't forget, the Swiss National Bank is almost a hedge fund of the tech unicorns. So that
The physical silver market is flashing red, and almost no one's paying attention. Vaults are being drained, inventories on COMEX and LBMA are plummeting, and premiums on coins and bars are surging across the board. Dealers can't keep up, wait times are growing, and some mints have already halted production due to lack of supply. This isn't a minor squeeze. It's the start of a full-blown physical panic. And unlike the paper markets, you can't conjure physical silver out of thin air. Once it's gone, it's gone. Over the last year, we've seen consistent outflows from registered silver inventories, with thousands of tons disappearing quietly into private hands and sovereign vaults. And here's the kicker. Most of this silver isn't coming back. It's being hoarded, stored, and removed from circulation. The market can pretend there's no problem as long as it wants. But the numbers tell a different story. We are in a structural deficit, with industrial demand outpacing supply year after year. Now combine that with surging investor demand, and the result is inevitable. A collision course between dwindling supply and exploding demand. That's when price suppression fails. That's when delivery defaults become real. And that's when silver stops trading like a commodity and starts moving like a lifeboat in a burning system.
I think the big thing that's not being spoken about is how wrecked the US banking system is probably in the moment. Bank of America made a purchase of 500 billion treasury bills when the rates were about 1%. That collateral has lost a huge amount of money. You can get the same yield with 100 billion that they paid for 5 billion, probably approaching now. That's an immense capital loss. I think if we were marking to market debt instruments in banks, you would have to conclude that we're trading bankrupt safely, I would imagine. And I don't think that's that different for many countries either, if there were mark-to-marketing process was entered into. And I think we're a short step away from a banking narrative because everyone's suddenly discovering the long bonds. Well, when they discover the long bonds, they've got to know that that's the tool for purchasing property. That's the asset that's created, a 30-year or a 20-year mortgage. And somebody has to be a buyer of that. Otherwise, the bank's got to sit on it on their own books. And what's the appetite to lend now when they've already holding too many lending-based assets of their own, and they've got a collateral of a house that could actually be housing, as I say, is mathematics. If the rates are twice what they were, the price should be half. Because people could only afford the same payment if they've not got an increase in earnings. And when you then look at the outlook for debt and the desirability of originating new loans, that's got to be worse than it has ever been because the debt markets have turned. That's why we said this is going to be the most significant call we ever made in September, because this is the technical call for reset. We all have said fundamentally this day would come, but no one could time it and say, when is it really? Everyone could just say, printer go brr. You can't do printer go brr because no one's buying the asset you're creating anymore. Just so that people are aware, the Fed is already intervening to buy. People are expecting rate cuts. The Fed is buying at the current interest rate. If you cut rates, you are upvaluing the bond. It's a bit like me saying, Elijah, buy my secondhand shoes for $100. And you go, no, thanks, Francis. And I say, how about $250, Elijah? Well, you're going to want it even less, I'd imagine. And that's what's essentially going to happen on bond markets if they even try to cut, which is why everyone's going, oh, the Fed's behind the curve again. Yes, they're usually behind the curve, but they can't move like you normally can. This time is different because the debt market has lost its footing and is now no longer a reserve asset of accumulation and that people want to hold. And in actual fact, gold is the beneficiary. I suppose that's the sunlight in what's a pretty doomer statement, is gold is here and it's big. Unfortunately, we're going to find out who owns the gold and who didn't. It's going to be a very polarizing event.
Silver just did something it hasn't done in years. It broke out. Technically, the charts are screaming one message. This is no ordinary rally. Momentum indicators are flashing green across the board. RSI is climbing, MACD is accelerating, and silver has cleared critical resistance levels that have capped its price for over a decade, when it sliced through $33.69 and $34.55. It didn't just tiptoe. It exploded, pushing toward multi-decade highs and triggering massive short covering. Traders who were betting against silver got caught flat-footed, and now the stampede is on. The price action isn't random. This breakout has been building beneath the surface for months, and now the technical floodgates have opened. Analysts are already eyeing $35.36 and then $37.46 as the next major targets. And if those go, we're heading straight for the all-time high of $50. But here's what makes this move different. It's not just driven by momentum traders. It's being fueled by fundamental panic. Every chart that once showed consolidation is now flipping bullish. Every dip is being bought, and every signal is pointing to one conclusion. Silver is waking up, and when it moves, it doesn't creep. It sprints.
I think the East really has the meaningful gold, particularly China. So the one thing I'll say to a uniquely American audience, I'd imagine, but much love as I have for all of you lovely people, the people that have managed your country have done you a disservice immensely. And I'm going to tell you it straight as it is. If you have a choice between being a producer nation that creates surpluses and stacks that surpluses in gold, yes, they are indebted, yes, they have a wrecked property market, and being a debtor nation that overspends consistently and undersells to others and borrows and creates debt instruments each time you overspend, in the event of a downturn and you stacking T-bills that people need to buy that they no longer want to buy and are devaluing, and the other person is stacking gold ounces, who is in the better position come reset? I think the rational amongst you that are not emotional will realize it's not a good position for America. And what I find is you get a lot of China is wrecked, China this. It's kind of like there's a problem, but let's point out how bad everybody else is. Just let's deal with the American issue. America's in huge trouble here, and it's not necessarily in the best position compared to other nations at all. And that's not me wanting to see a communist nation win over a supposed capitalist nation. It's a hard fact. It's a real downgrade in living standards for Americans coming in, on the basis of that, as I was saying, as the taps get closer to closer, it's devaluation of debt and currency, you're going to have the worst buying power in your fiat currency as a result of the loss of ability to borrow. And you're eventually going to have to live within your own means. And the issuance of debt is going to become less and less of an option because no one else will buy it apart from your own Fed. And they're already doing it to a degree. And the degree that they'll be able to continue beyond what's already a technical bankruptcy position is highly, highly limited. And everyone else will sell it until they own everything. And I don't think the people that own the Fed are that excited about that notion. So we're being prepared for the new financial system. So I don't think this gets to play out that we see debt valued at zero. We start to see real collapse. There'll probably be other geopolitical smokescreens going on and chaos, shock and awe, their financial equivalent. And then we're going to go, hey, guys, we need to do this. The banks got hacked. This happened. So we're going to get circuit breakered into some new system. And we've discussed this before, and it's becoming very close to a fait accompli right now.
The Federal Reserve is trapped in the most dangerous corner of its existence. Inflation is still running hot, but the economy is faltering, and debt service costs are spiraling out of control. Raise rates, and they risk detonating the banking system and triggering mass defaults. Cut rates, and they destroy the dollar and unleash even more inflation. Either way, confidence erodes, and that erosion is now accelerating. Markets are finally waking up to the truth. The Fed isn't in control. It's reacting, not leading. And every move it makes digs the hole deeper. Investors can see the trap. That's why capital is flowing out of bonds and into metals. That's why gold is punching through resistance, and silver is igniting. The Fed's credibility is hanging by a thread, and it knows it. Just look at the balance sheet. Despite the talk of tightening, it's quietly swelling again as emergency facilities get reactivated behind closed doors. Liquidity is being funneled in through back doors, and the market smells it. They've lost the inflation narrative, they've lost the soft landing fantasy, and now they're losing the last thing they had left, belief. This loss of faith is turbocharging silver, because silver doesn't need trust, it just needs demand. And the more the Fed scrambles, the more demand silver commands. The monetary metal is no longer just a hedge, it's a protest vote, a rejection of the entire fiat experiment.
I think they need a lot of pain and suffrage, a big problem, to create a big reaction, to then drop their new solution. And I think a lot of people have seen this coming. So it's going to feel a little bit like the CV19 events, where there's going to be a lot of skepticism and a lot of anger. So I could see, again, I don't do this to be dramatic, please believe me. But I just think the scale of this issue requires a very scaled response, a big problem, a big reaction. So they might keep everyone's head under the water in this waterboarding exercise a little longer, so that you really come up gasping. We have to sign on the dotted line for almost anything. We have to be so on our knees. And I think that could affect a lot of things that are day-to-day needs. It can be power related, it can be access to food, etc., etc. They are going to push this problem. We're going to get a stark reaction, and then we'll accept whatever solution they give us. Because this is I don't think every lifetime gets to see this degree of economic travail. And I think we get a totalitarian nation and global order that comes out of this, which is quite concerning to me. Good news. Let's say something good news. Florida got gold passed as money. And a legal tender. So I love the fact that happened, and I'm upset that David Webb couldn't get it through in Utah, and that there was a I think it's a senator, the head of that particular state. It's probably called a senator. I'm not sure. I don't understand American politics as well as you would, but he vetoed it. We really need to show up because the bank lobby from out of state showed up to stop that from going through. We really need to see victories like Florida's victory, where gold and silver as legal tender and no taxes for having it or purchasing it, those kind of laws. We need to see more of that. We can't be NPCs and sit here and just say, I bought my gold, I've done my bit. We've got to get the laws through. We've got to get people accepting sound money.
The alarm bells aren't just ringing, they're deafening. Robert Kiyosaki, Peter Schiff, and other financial veterans are screaming from the rooftops, warning of a historic crash that could vaporize unprepared investors. And what are they doing? They're moving out of stocks, bonds, and dollars, and loading up on silver. Kiyosaki just called silver the greatest bargain of our lifetime, predicting it could triple or more in the chaos to come. Schiff has echoed the urgency, pointing to debt, deficits, and inflation as a perfect storm for a silver surge that will catch most people completely off guard. These aren't just doomsday soundbites. They're strategic moves based on decades of market observation. Every single time the system begins to crack, silver plays catch up with gold and then goes vertical. These experts understand the rhythm of financial collapse. They've seen the early tremors before the quake. And right now, they're not just talking, they're acting. The retail crowd is still asleep, chasing tech stocks and crypto rallies, but the smart money is positioning itself where it always does before the storm, in undervalued, tangible, uninflatable assets. Silver is no longer just a trade, it's a survival strategy. And when the wave hits, the few who listened will be miles ahead, while the rest scramble to buy silver that no longer exists at prices they can no longer afford.
Platinum's last high was here in 2008. So let me get my big pink Koki. This is 20 years of metals, by the way. Let's just highlight this 20 years of metals. And I've got a couple of metals on here. So the blue is silver. That's XAG is the blue. The gold is orange. So the orange is gold. That's XAU. And then the gray is palladium. This one that had a huge run up to there. And then the actual candles chart is platinum. And then I just put in for fun rhodium. It's very, very small. I don't think you can meaningfully buy it. There's a ETF you can track. It's along with palladium had this huge run into 21. So that's rhodium. And you can see palladium also a huge run. They were eating platinum's dinner, particularly palladium, not so much rhodium. It's a unique metal, rhodium, a very small number. But you can see platinum was actually barely moving and actually drifting off. And it started over here. You could see palladium was separating itself from platinum already. So the palladium begins to overperform. This is part of the end of the diesel engine, wanting, to kill the diesel engine, particularly green agenda. This was extreme palladium overperformance to platinum. So platinum was really left behind. It had a bit of substitution taking place as well, going on. All the money was going into that. And then that was the peak for the palladium platinum 2020-21, just into the early part of 2021. So there's a couple of things happening there. And then I will show you gold in this chart began its run more strongly from around here once it broke out. So gold is the reserve asset since the debt failure. The debt failure that we called end of 2020 really only started end of 22. People started to go, damn, this isn't right. What's going on in the debt markets? So the gold started to get the substitution for T-bills really here. Silver partially participated, but not to the same rate. So there's been a broadening and an expansion, and we are sitting very low vol on the 100 gold-silver ratio, a separate point, by the way. There's a breakout in one of the directions. I don't know. I'll wait and see coming, potentially. Rhodium and platinum corrected really hard. My apologies. Rhodium and palladium corrected really hard after this pink line. So they lost 60%, and rhodium actually lost 80% from that April high. So they had real rough corrections. Now, platinum, if we look at it just on its own, because it's very difficult to see in that.
Behind the headlines and distractions, a global resource war is already underway, and silver is right at the heart of it. Nations aren't just fighting for oil or territory anymore. They're scrambling to secure the critical raw materials that will power the future. And silver, with its unmatched electrical and thermal conductivity, is the metal every industrial superpower needs but can't seem to get enough of. From solar panels and electric vehicles to defense systems and AI hardware, silver is irreplaceable. China knows it. That's why it's been locking down supply chains and cornering production through aggressive mining investments and domestic stockpiling. The European Union knows it too. With new green mandates and the Critical Raw Materials Act in motion, the EU is scrambling to ensure access to silver and other essential inputs. The West is realizing, too late, that years of outsourcing and environmental red tape have left it dangerously exposed. Silver isn't just an investment anymore. It's a strategic asset. This new arms race isn't being fought with bullets. It's being fought with contracts, legislation, and supply chain control. And as nations race to lock in future access, the free-floating silver available to private investors is vanishing. If you're waiting to buy, you're not just competing with hedge funds. You're competing with governments. And in that kind of war, the price doesn't rise slowly. It gaps up violently.
And I just bring up a platinum chart. This is a massive falling wedge of devaluation period that's then broken out of. So we eventually broke out of that, and then we're in a nice squeeze for the first upside in a new trend. And the Chinese, we're hearing, are buying. And I bring you back to the gold-silver ratio. It seems when gold goes up to 107, maybe the Chinese are buying more platinum. They're looking at the relative silver. Silver. When we're at 107, and then when we fall below 100, the gold bid comes back in. So you might be finding that now platinum is being included in that, having not have moved. It's incredibly rare metal, and it is Russia and South Africa are basically 70% of the market plus in terms of mining. They're hardly the bastions of stability. And they're both on the BRICS side of the fence. So you're getting interesting points. Zelensky came into South Africa. Few Americans will be aware of this. Met Cyril Ramaphosa, who was the gentleman you saw the recent Trump theater with, and bought Northplatz, which is a big platinum provider, 51% controlling stake. Now, Zelensky's got a lot of interesting billionaires who are behind him that got him the role that he has. And you can make of whatever you want with the Ukraine war and all that goes on. But it's fascinating to see them choosing to invest in this way and buying South African platinum producers. So I'm quite almost shocked and a bit disappointed that that's been allowed to happen. But I throw that in as an interesting anecdote for you. So I would expect that it's a well-timed investment, could well turn out to be the case. And in actual fact, it is currently barely much higher than its price of 20 years ago, while most of the others are still significantly higher. So I do think it has a real run. By the way, Americans, you don't pay VAT or typically sales taxes on it, so you can essentially buy it for roughly spot plus a spread, a dealer spread. So it might be an interesting one to have. Just bear in mind, if you're a seller, it's a bit unique, and they don't typically come coins, so you'll probably be buying bars, and you may find capital gains taxes are being applied on later on bars, while numismatic might get a little bit more slack. So there's some things to bear in mind, but the overall catch-up could actually see platinum do a bit of a palladium, what palladium did when it was really in season. You could have an absolute blowout run. That was huge from palladium. Rhodium is such a thin market, it's very difficult to even treat it as a use case example, but that's what happens in thinly provided, highly sought after metals. And I think platinum is way down here in terms of where everything else is, with gold over there. I spend most of my years with platinum being a much higher gold price, higher than the gold price as an asset in dollars, and it's rarer. So who knows? It's just not as monetary. So it's a little bit of wild card in it.
We've crossed the line from casual interest to full-blown obsession. Silver is no longer being treated as an asset class. It's being hoarded like a lifeline. What started as institutional positioning has now spilled over into the public. But this isn't the same retail investor from 2020 hoping for a quick pump. This new wave of stackers is buying for survival. They're not trading silver. They're removing it from the system. Every ounce bought is one less ounce available for the next buyer. And as premiums rise, so does the urgency. Physical dealers are reporting record sales. Coins and bars are flying off shelves in days, not weeks. And the message from the stacker community is crystal clear. They don't trust the banks, they don't trust the paper markets, and they certainly don't trust governments. They want silver they can hold. They want insurance they can see. And every new geopolitical shock, every new bank failure, every new inflation print only adds fuel to the fire. What we're witnessing isn't a temporary spike, it's a psychological shift. Paper wealth doesn't feel safe anymore. Fiat savings don't feel real. But silver? That feels like protection. That feels like a future. And as more people make that realization, the price isn't just going to rise. It's going to melt up in a rush that leaves the mainstream breathless and behind. The fuse is lit and the countdown has already begun. Silver isn't just creeping higher, it's preparing for a detonation. With global debt imploding, banks on the brink, and nations rejecting the dollar in favor of real assets, the conditions for a silver supernova are now locked in. This isn't hype. It's math, history, and supply and demand reality colliding all at once. The $500 mark isn't a fantasy anymore. It's a flashing target on the horizon as physical scarcity, monetary panic, and geopolitical shifts converge like never before. If you've been watching from the sidelines, this is your wake-up call. The institutional players have already moved. The smart money is already stacked. What's left is the moment the floodgates break and the masses rush in, only to find the shelves empty and the price climbing with every tick. Silver is no longer a hedge. It's a statement, a shield, a rebellion against a broken system. So if you see the writing on the wall, don't wait for mainstream confirmation, because by the time it comes, the opportunity will be gone. Subscribe if you want to stay ahead of the reset and keep your finger on the pulse of this unfolding storm. And remember, this is not financial advice. Always consult with a licensed professional before making any investment decisions. Asa Business